Do you remember as a kid, Mr. Toad's Wild Ride? One of those roller coasters that as a kid was so frightening? Well, roller coasters still frighten many of us, and most of us are thinking that interest rates are a lot like riding a roller coaster. There's that pit in the center of your stomach and you're just not sure what to do, but you know you've been on a roller coaster for the last couple, 3 years, and you're not sure when it's going to stop or when it's going to get stable so that you can either get off the ride or, more importantly, go in a new direction. I'm Mike Miklas with Team Integrity, powered by Success Mortgage Partners. If you want to know how to buy a home, subscribe below. We cover all the different ideas that you're going to need. Well, rates really, as wild as they seem, haven't been as wild as most people think. Rates right now are at about 6.5% as I'm talking today in early May, but the reality is that they were at about 6% in January. And in January, I'm just going to take a hunch, you were probably thinking, gee, I'll just wait till rates get into the fives, ignoring the fact that just a little over a year ago, rates were over 7%. So today I want to talk some common sense, and I want to get you off of the ride and into reality. Because the self-imposed roller coaster of interest rates that you're riding is probably causing you a little bit of disequilibrium, I believe is the word. In other words, you're just not sure what to do next. And I think I'd like to help you with that, because waiting is probably not helping you. I hear the fears about the market bubble. I hear the fears about maybe houses will collapse. I hear the fears about the Fed chair is going to change. I hear the fears about the Iran war and what's going to go on with that. And yet every time I hear these fears, I look at borrower patterns, especially here in the Sacramento marketplace, and the fears just don't match. Are you aware that in the Sacramento market, now think about this, pending sales are the highest that they've been in 4 years. That's right. People are stepping out, they're stepping off of the roller coaster platform, and they're actually buying homes. So what do those people know, perhaps, that you don't know? That's really one of the questions that I want you to think about. Because even though rates are at 6.5 and not 6, if you're waiting for 5, you might be waiting for the wrong reasons. Because instead of needing lower interest rates, you might just need a different mortgage advisor. First, let's look at some of the facts on why homes that are pending at the highest level in 4 years are so meaningful. First of all, the average home price in the Sacramento area is at about $600,000. Now that's down from $605 a year ago. But what is the average home price? It's different than the median home price. It's the midpoint between half the sales were below and half the sales were above. The median sales price, which is the aggregated average, is actually about $686,000, a much higher number because there's a higher preponderance of houses selling at $600,000, $700,000, and $800,000 than at any other dollar amount in our marketplace. And that's actually up from about $674,000 a year ago. So the median is creeping up even though the average is staying flat. This is also true for median and average days on market. The median number of days on market is 13 days. That means if it's listed correctly, homes are selling. But the average days is staying the same at about 36 to 37 days, which simply tells you that when homes sell, they're selling and then they're closing, and they're closing at a fairly short period of time. Here's a trivia question for you. How many offers does the average listing get in Sacramento County? It's 2.25. In other words, it's pretty typical for there to be more than one offer on every home. So the market is a competitive marketplace, even though it's somewhat of a buyer's market. So what I'd like to do for a minute is I'd just like to have a real conversation about payments. If you take a $500,000 loan, I'm using that number arbitrarily because it's close to the median sales rates And more importantly, it's a simple number we can all work with. At 6.5%, the payment's about $3,160. Now at 6%, the payment will be $2,997. That's only a difference of $163. So the payments have basically gotten $163 more expensive than if you had bought in January on the same loan amount. But is that the reality? Is that what's truly holding you back, $163 a month? Because the truth of the matter is, taxes and insurance are both larger factors than the change in the interest rates. It's fairly typical in our marketplace for homeowners insurance to be anywhere from $2,400 to $9,600 on pretty much the same size house, simply depending upon where you're looking to buy it. So if you're really concerned about or curious about what you can afford and what you'd like in a monthly payment, you need to narrow down where you want to be and then take a realistic look at what the property taxes are in that area and combine that with what the interest impacts are going to be because of the crisis in insurance in the state of California. Insurance and taxes are way more variable than interest rates, and you need to know that. And that takes having a conversation about dollars and cents and getting away from percentage signs. You know, a wise friend of mine once said, you can't take a percentage sign to the marketplace and buy groceries, but you can take dollars. So let's talk about what you as a buyer should focus your focus upon if you're considering buying a home. And here's what I want to know when I first meet with every buyer. What would buying a home mean to you? I mean, really, that's the heart of it. If you have a personal connection with having a desire to own a home, to provide safety for your family, to have the freedom to paint a wall once in a while a color because you chose to paint it without having to get permission, to have your kids in certain schools in a certain school district, or be convenient to bike paths and be able to go cycle riding if that's one of your hobbies. Those are all in here and they're personal. Those are the real considerations that you need to have a conversation with yourself about when you go to buy a home. And then a good mortgage advisor is going to have that same conversation with you at the same time they're assessing your situation. So what would be some of the things we'd look at? Well, one would be your income and its stability. The truth of the matter is your income and its stability is the single most important determinant in terms of you being successful to own a home. And the second would be, do you have a cushion for emergencies? In other words, what's your cash situation? Now, I'm going to take a moment here and talk about down payment. David Ramsey and Uncle Harry are probably going to tell you on a $600,000 house that you need $120,000 down. Gosh, I wish they'd stop having those conversations and scaring buyers out of the reality that they could buy a home today. Because the truth is, on a $600,000 home, you only need $18,000 to $30,000 for your actual down payment. Now, true, there's closing costs and prepaids and some additional conversations we need to have, but a real mortgage advisor, after we have that conversation, is going to want to know that you still have some emergency dollars, that you have an ability, in case of an emergency, to still be successful owning that home. That's what a true mortgage advisor cares about. And then the third thing that we care about is, are you being realistic about the payment? I want you to be prepared when we have a conversation for the fact that your payment is going to go up in small amounts, incrementally, year after year after year, because taxes go up year after year after year, and so does insurance, because the insurance factors change over time because the cost to rebuild a home changes. So these are real, and you need to be realistic. And then finally, how long do you plan to live there? You need to know that if your horizon or the timeline that you think you're going to be in a home is only 2 years or 3 years, buying a home is probably not a good idea. A minimum time horizon of 5 to 7 years in your first home is a more realistic analysis. So let's recap. Home prices are flat and they're slowly increasing. So know that there is not going to be a collapse of housing prices, especially in the Sacramento market. We have a shortage of housing that's available, and homes are being built at considerable numbers and selling quickly, even during this time of instability of rates. The second is that rates may not go lower. We have to be prepared for that. You know, the Fed has a balance sheet where they bought mortgages during that period of time when they kept their thumb on the scales, and they haven't run that complete balance sheet off yet. That's something the market isn't even talking about. But a knowledgeable mortgage advisor would know that. The third thing is that 45% of all sales today have some form of seller concession, which says that it's truly a buyer's market right now. Even though there's not a long months of inventory, the time of purchase is short. Just the fact that properly listed houses are drawing 2 or more offers, combined with the fact that the seller wanting to sell for their own personal reasons is offering concessions, tells you that it's an active market. 45 out of 100 homes have some form of seller concession. And last month, the average was $8,633. That's a significant help toward closing your transaction. Now, your wages, if you're like most people, have been going up. In the last 4 years, the average W-2 worker has been seeing an increase in their wages from 3 to 5% per year, which means that your position to buy a home today, 4 years later, is better than it was 4 years ago, because home prices have been relatively flat during the past 4 years. At the same time, your wages have been going up. So when it's all said and done, what's the real risk? The real risk isn't putting yourself through the emotional roller coaster of Mr. Toad's wild ride of interest rates and using that as an excuse not to buy a house. The real risk is waiting when you probably shouldn't be. If you have stable income, if you have been desiring to buy a home, you might still need to wait. But the only way you're going to know whether you should wait or buy, in other words, the only way you're going to know if you can be approved or have a plan for a future approval, is to sit down and have a conversation. My team here at Team Integrity would love to put all of our resources with Success Mortgage Partners to work for you. So DM me or reach out and give us a call, and let's get you on the calendar and have a conversation.